The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 5th of December. Welcome back, Jeremy. Good to have you here again.
Hi, Gareth. Yep, good to be here.
And I'm feeling slightly under the weather this morning. We've had our progressive Christmas lunch yesterday, which is good as always. So it was great to see the team and good to catch up. But while we've been partying and enjoying ourselves, the world has carried on. And it's been a slightly different type of week this week, a bit unusual. What have you been looking at? What's caught your eye?
So December started in risk-off mode. And we've discussed before the nature of the Bitcoin liquidity barometer, slid sharply over the weekend, and people came in Monday morning with the Bitcoin price down sharply. All the headlines were out in unison across mainstream media saying this was obviously it in the end. The Ponzi scheme of cryptocurrency was finally coming to its ultimate conclusion.
Right.
As I've mentioned before, I take a slightly different view to that.
You do. Well, that's fair. But I think what you have said, and I guess this is a very good case in point, is that, yes, Bitcoin, you can think what you like of it, but it is a very useful indicator of lots of other things. And it sounds like this week that there's an awful lot of those playing. Yeah.
You can take it or leave it. You don't have to own it. Whatever you do think of it, it is a helpful indicator of things that are going on elsewhere. It is very sensitive to the impact of liquidity. And at the moment, there have been multiple things impacting Bitcoin all at once. And the trend has clearly been negative. And one of the things that has been highlighted at a time when precious metals are going sort of from strength to strength, gold is a tad below its all-time high. But this week, silver lurched through its all-time high. I think at one point it almost reached $60 an ounce, which I think 18 months ago it was sort of less than half that value. Bitcoin's gone the other way. Bitcoin's sort of down 30% from the high. And I just thought it was worth having a ponder of what's going on here.
Yeah, because that does seem odd, given that a lot of people talk about Bitcoin as a hedge against inflation, and gold and silver should be the same. So yeah, interesting. Good to unpack.
So the fact they're going in different directions, I think it's too simplistic to say, well, clearly this proves that the thesis that Bitcoin are those things is wrong, because those of us who watch small cap companies are aware that the price isn't always right, or the price can often veer off a long-term trend for no real reason. And that is the nature of things that are illiquid and have problems with market structure.
Mm-hmm.
As I see it, I think there are probably four main things going on here. One is that the relatively close correlation between Bitcoin and technology stocks. And I think the most obvious sort of explanation for this is the sort of overlap of ownership. You know, the origins of Bitcoin and cryptocurrencies were among the cypherpunks 30, 40 years ago. And yeah, there is a much closer correlation to technology and concerns over the AI bubble with Bitcoin than there has, say, been with gold. The other one, which I think is an important factor here, is something we've talked about before, and that's the impact of the way Japan finances itself and the way the world uses the yen to finance risk assets.
Mm-hmm. The carry trade, yeah.
So the unwinding of the carry trade, of which there is clear evidence that is underway in a relatively controlled way at the moment, but a significant way. You just got to look at the rise of the 10-year JGB yield in recent weeks to know that something here is going on. And I think that's influencing all risk assets, and Bitcoin is feeling that as well.
Okay.
The third one is an interesting one that we made aware of this week, and perhaps it's a complete red herring, I don't know, but there's a guy called George Gannon who writes on Substack, and he has pointed out the close correlation between Western aid to Ukraine and the Bitcoin price going back to 2014. Now, we all know that correlation and causation are very different things, but clearly we're becoming increasingly made aware that some of the money, hundreds of billions of euros and dollars that have been sent to Ukraine, how do we put it, haven't all been spent on defending the realm.
That's one way of putting it, yes. Okay, so the thesis might be that some of that ended up in Bitcoin.
And increasingly, there's evidence that what's been going on in Ukraine is coming to some form of end point, whether it's the collapse of Ukraine, whether it's military victory of Russia, or whether it's just the exhaustion of the West in being able to support Ukraine. All those things are coming to a point where anyone who is in the waterfall of funding from that huge flow of money, of capital, is probably thinking that they need to do something with whatever it is they own. And if they own it in Bitcoin or any other crypto asset, maybe now is the time to go and buy that large piece of land in South America.
Okay, so there may be a cashing out play happening.
The fourth one is, I think, more relevant, and that is this thing called the Bitcoin Treasury Company, which we talked about at some point during the early part of the summer, where the UK was caught up in this Bitcoin treasury effect, basically companies copying MicroStrategy, now called Strategy, and the Bitcoin evangelist Michael Saylor. The biggest of that cohort of UK Bitcoin treasury companies, the Smarter Web company we talked about back in May, June time, at one point traded at £5 a share at a multiple of the value of the Bitcoin it owned. Those shares now change hands at 40p.
Right.
And
okay.
a significant discount to the value of the Bitcoin it carries on its balance sheet.
Right. So the luster has come off these Bitcoin treasury
companies.
companies.
Has come rushing out. And people are saying, well, it might be the end of Bitcoin treasury companies, certainly as we knew them. And really, the model only worked if and when the Bitcoin price goes up. So too early to know would be my comment. So I think all those things are going on. And some, if not all of those things, at some point will dissipate. And there is probably another factor going on here, and it's affecting wider markets. And that is the whole debate around who's going to be in charge of the Federal Reserve after Jay Powell steps down next year. Both Trump and Bessent have this week continued to make noises in the media and to journalists about that process, who it might be. And it's clear that the market feels there is an opportunity and a risk of having a overt dove running the Fed. The popular narrative is that Kevin Hassett will be Trump's man in the Fed. Whatever the data says, he's going to bring rates down because Donald told him to.
That's the deal, I'm sure. Yeah.
But that is the broadly accepted narrative. And in that situation, then you would have thought that would be positive. I mean, it's been positive for precious metals. I think you would broadly expect that to be positive for Bitcoin.
Got it. So there's obviously a lot more going on here than meets the eye.
But I actually don't think the narrative is as simple as I've just described it, because I don't think Bessent would allow that naked undermining of Fed independence, because if for no other reason, he's got to refinance a lot of debt. And by doing it too overtly and in that sort of fiscally dominant way, where the Treasury are basically dictating interest rate and monetary policy for the US and for the dollar, then the policy rates will come down, but the 10-year yield is going to go through the roof.
Absolutely, yeah.
That's the best way of getting gold to $10,000 and Bitcoin to $250,000.
Yes, Bessent's got a bit of Trump handling to do.
Yeah.
So lots going on there. Meanwhile, the UK's been sort of digesting the budget. We had our quick reaction last week. How do you think these things have impacted on the way markets have received Rachel's offering?
I think it's let her off the hook. And within all this, there's another aspect that's going on here that we haven't really talked about, is this whole issue occupying the EU at the moment. European leaders applying pressure to Belgium to seize Putin's remaining assets sitting in Euroclear. And all these things going on have been forcing the dollar back down. So the dollar is now back down below 99 on the DXY. So the headlines are saying that, the pound's doing okay, whatever it is, 133, 134. And so if you just look at how the market has reacted a week after the controversial second Reeves budget, gilt yields are down a bit and the pound's stronger. So,
So it sounds okay.
To be fair, survey data out this week shows the UK to be a bit stronger than people expected. The commentary I've read from people who make it their business to understand these things are now saying, well, we've had the one-time reset on employment costs last year. We've adjusted to that. We've now got to sort of adjust to the tax changes in this recent budget, and that's all got to go through the ringer. And we've promised that she's going to leave us alone and only do this once a year going forward. So if we get through all this and demand in the UK economy hasn't been destroyed and we can demonstrate some resilience, then maybe moving into next year with this higher than expected rate of productivity in the UK economy that the OBR have been going on about, then maybe some of these GDP numbers can start going up again. So there are some grounds for optimism. So, yeah.
Yes, perhaps Rachel's got off slightly lightly because the markets have been kind to her for other reasons, but talking to people and seeing the sort of the slightly slower burn reaction to the budget, it doesn't feel like many sectors have been particularly badly hit or in ways that weren't expected. I think some of the gambling stocks, the online gaming has been affected by, some specific things that did come out of the blue. But overall, investors haven't taken to it as badly as they had a previous budget. I think it doesn't feel as bad. So yeah, you're right. If things can move in the right direction for a while, we could get into 2026 on a more positive note, which would be a great place to be. What about in the more immediate near term? What have we got coming up over the next week or so?
We've got some trade data from China on Monday, expected to show a modest decline in export growth and a modest increase in import growth as China looks to stimulate its consumer economy. In the US, it's jobs week without the jobs data. So,
okay, the legacy of the shutdown.
We get two lots of job openings data for September and October being released, I think, at the same time, which should show a consistent picture of around 7 million job openings in the US economy. That's sort of the unchanged figure. On Wednesday, I think it's the biggie. We get the Fed funds rate decision. It's not really about the decision. I think it's sort of 90% certain that they are going to cut from 4% to 3.75%. But the chairman's press conference afterwards, I think, will be pretty interesting viewing for those who are so minded to watch these things. No doubt be asked to comment on his position and who his replacement's going to be. And
independence on the line once again. So,
yeah, there's that. And obviously then there's the dot plots and where are we going? What's the trajectory here for inflation? And as importantly, how do policymakers respond to whatever that inflation trajectory is and who's going to be doing it? So lots of balls up in the air. And on Friday, we get UK's GDP data for October. So September was negative 0.1%. I mean, I think it's sort of a coin toss which side of zero this figure is going to be. And I think it's going to be more relevant as to what trajectory we hit the ground with in the first quarter of next year.
Yeah. And your comments on the potential removal of Russian assets out of Euroclear and whether that goes ahead, that might be quite a driver for news flow over the next week as well.
Yeah, my new political hero in Europe is the Prime Minister of Belgium. He seems like a real solid guy and quite a character. So, yeah, as we know, if any war is fought in Europe, all the important battles take place in Belgium.
Waterloo onwards, yes. Right.
The battle of what happens to Putin's assets, the majority of which sitting in Euroclear in Belgium, and what the Belgians decide to do. And it's all very ironic that ultimately they're saying they don't trust the EU to support whatever decision is taken because Belgium's going to get it in the neck. And yet, obviously, they're the main host country to the apparatus of the EU itself. So,
if they don't trust Europe to come to their aid, then who else should? So, yeah, interesting. Yeah.
That has really significant implications for people's confidence in the dollar. And if there is an issue that should occupy the minds of anyone interested in financial markets, it's the confidence in the dollar. One could say, it drives everything else.
So if they remove these Russian assets and give them to Ukraine in terms of aid, the argument would be that the dollar is a less attractive place to store your money. Let's see what happens.
All right.
An exciting week. Good stuff. Okay, thanks for your time, Jeremy, and we'll catch up next Friday.
Okay, see you then.
Talk to you then.
Brought to you by Progressive Equity.